Dean and Tyler Listle are registered investment advisor representatives. Investment advisory services offered through Brokers International Financial Services, LLC, member SIPC. Brokers International Financial Services, LLC, and Secure Retirement Solutions, LLC are not affiliated companies.
It's time for Secure Retirement Solutions with your hosts, Dean and Tyler Listle, fully licensed retirement specialists from Secure Retirement Solutions in Green Bay. Now, here are your hosts, Dean and Tyler.
Good morning and thank you for joining us today. Tyler and I will discuss topics that affect your retirement, such as investments, income planning, Social Security, and much more. How are you this morning, Tyler?
Good morning, Dean. I'm doing great. How about yourself?
Good, thank you. Today we're going to talk about investing tips. It's a good subject to talk about. We tend to have a lot of clients and investors who come into the office and they just want to pick up on things that they should look for in their portfolio or what type of tips they should be using when buying certain investments if they self-manage. So today we're going to talk about some basic tips. We're going to talk about the economy a little bit and so on. And really when it comes to investing tips, before we get into it, we do want to talk a little bit about a topic here, and that is mainly, how do recent tariffs and sanctions affect the stock market and my investment? And we hear that a lot lately. And just so you do know, they do affect your investment portfolio. They do affect our economy. So Tyler's going to take you through really what sanctions and tariffs are. And then we're going to talk about how they affect your investments and whether you should be moving investments around as a result of sanctions and tariffs.
Yeah, Dean. So jumping right in before we kind of get into the bulk of the investment tips, based on the current state of our market and economy, we've been getting a lot of questions from clients. How do the recent tariffs affect the economy, stock market, my investments? One of the main topics that we have right now is a potential looming trade war with China. That's a buzzword that we hear quite a bit is, the trade war. You hear that in the media, on different investment websites, and just in your day-to-day life right now. But really, to start off, when we talk about tariffs, all the tariffs that are being imposed on Chinese imports, and then China retaliating and putting tariffs on the U.S. So in simple terms, a tariff is a tax. So a tariff, it adds to the cost of goods, and it's one trade policy that countries can enact. So in the most basic terms, when you hear the word tariff, it's simply a tax. Now, recently, the U.S. has imposed tariffs on billions of dollars of goods that are imported from China. On this last Thursday, there's talk that Trump is ready to put tariffs on all $505 billion worth of Chinese imports, and then those are all going to have tariffs put on them. So again, it's big in the economy right now, and it's all part of what we've heard in the news recently known as fair trade. That's the Trump administration. They want fair trade. Over the last few years, over the last few decades, there's been talk how China has really gotten away with unfair trade, and Trump is trying to go back and make it part of the fair trade. However, tariffs and trade, it can come with a price. With tariffs, jobs can be lost, and consumers, they can pay higher prices when other countries retaliate, which is what we're seeing with China right now, where there's people in the steel and aluminum industries, there's different farmers that can really feel the brunt or can really feel the blow of these tariffs that China is retaliating with, and that can come with different jobs being lost and consumers paying higher prices for those goods and services. Now, when we talk about the stock, so that's what happens with the economy. Prices can go up and there can be jobs that are lost. But then with the stock market also doesn't like the thought of tariffs or a looming trade war, simply because U.S. companies can be affected and so can international companies, which will then drive their stock prices down. You have jobs that are lost. Companies try and save money when there's tariffs that are imposed on them. So it potentially does affect the stock market as well. But Dean, why don't you take our listeners through, as an investor, what you can do to try and counter the tariffs and stuff like that? What do you do as an investor?
Okay, and before we really hit on that, Tyler had one item here that I want to expand on a little bit, and he said that tariffs are really a tax. Now, understand, the United States just went through tax reform, which was signed into law, which gives some relief to individuals as well as companies when it comes to taxes. Okay, how is the tariff affecting individual investors? We're seeing a lot of people come in, they're very worried about tariffs and sanctions and how it's going to affect their portfolio. And with some of the stock positions, we have seen it directly, especially when it comes to the tariffs imposed on aluminum and steel that was first discussed. But remember, tariffs and sanctions, a lot like something like the Brexit vote of a couple years ago and the discussions and the stagnation of discussions over NAFTA and things like that, trade agreements, those are geopolitical issues. They really are not affecting the marketplace from a standpoint of strength or weakness. They're not really affecting the economy from a standpoint of strength or weakness. We're still seeing very good fundamentals out there in the economy and in the stock market. So when we look at geopolitical issues, those are usually short-term bumps or volatility. So when it comes down to making changes in your portfolio, for most people, we're saying, let's stay the course at this particular time. Just 6 months ago, what we thought was a pretty significant and good investment in a portfolio is probably just as good now because of the basic indicators such as the economy and the market itself showing very good favorable indicators. So if that's the case, do we really need to make wholesale changes? One of the mistakes that can be made, whether it be an investment advisor or an individual investor, is making significant changes due to some of these short-term geopolitical bumps in the road. Most people will stay the course, not always. We will still see some portfolios that are skewed very heavy towards those particular investments, which will take the brunt of tariffs and sanctions. And Tyler, we have a couple of them that we see, and let's discuss those a little bit.
Yeah, Dean, so like you said, what investors can do is the most important thing is simply stay the course. Usually something like this isn't going to have too big of a direct impact in the short term or in the long term. It might in the short term, it does in the short term, but over the long term, it's not going to have a huge impact on individual stocks. So one thing you can do though is to continue to monitor your holdings, as a full-fledged trade war could potentially make for a shift into more US-based investments that aren't hurt by tariffs or trade. So for example, Apple, almost everyone knows of Apple. iPhones are all over the place. They make a bunch of different technology gadgets, different things like that. But Apple generated 20% of its total sales for the first quarter in 2018 by selling to Chinese consumers. So China does make up, a fifth of Apple's sales. That's a big portion right there. That shows how, directly these tariffs come down on a company, which can then affect the stock price. The other thing, Boeing, they've been doing very well, Boeing stock, but sales for China amounted to almost 13% of its total revenue in 2017. And to go along with Boeing, Caterpillar has gained almost 22% of its 2017 revenue from China due to their construction boom. So right now, China's in a construction and infrastructure boom. They're rebuilding different roads, bridges. They have a lot of machinery over there. So Caterpillar has gained 22% of its revenue in 2017 from China. So there are companies, U.S. companies, that are directly affected by these tariffs on China because they do get quite a bit of revenue and make a lot of sales in the Chinese market. So directly, these tariffs do affect the economy, stock market, and stock prices. But over the long term, stay the course, continue to monitor your holdings. One thing that might be helpful is to rebalance your portfolio, take a little bit of profits off the table. Apple, Caterpillar, and Boeing have all been doing well as of late, so you want to take some of those profits off the table, maybe cut back, sell off a few positions within Apple or Boeing, for example. But just know that if you hold them, like Dean said 6 months ago, they're probably just as good right now. But continue to stay the course, monitor what you have. Don't just let it go by the wayside.
Right. And, when we bring up individual stocks, we're not making a personal recommendation. We're bringing up Apple, Boeing, and Caterpillar as an example as to how they could be hit and through tariffs and sanctions and where some of their sales are. So we're not making an individual recommendation. What you need to do is make sure you sit down with a professional advisor and find out, what parts of your portfolio should be changed around, if any, due to the sanctions and tariffs. Okay. The next thing we're going to talk about is don't try to time the market. We here at Secure Retirement Solutions, we believe very strongly in risk-managed investment portfolios. Okay, that's a mouthful. And what that means is we will have a number of clients. They're in stocks, bonds, mutual funds, whatever the investment is in the market. Anytime you're in the market, you're taking risk. I don't care how conservative your portfolios, you are taking risk. Nobody knows tomorrow what the market's going to do. However, as an advisor, it is your profession. You're intertwined with the market. You know what's going on with the economy. You're constantly studying different stocks, and so you have empirical evidence. You also have the experience to help these people out to try to mitigate downturn. One of the best ways, though, through a method is called risk managing your portfolio. It's a situation where you do hold cash in the portfolio at all times to be able to buy in if the market goes down. Which is a wonderful thing to do, to be able to buy low with cash that was created when the market is high. So as Tyler said, you take some of your gains off the table, you give a haircut to those particular investments that have significant gains, move some of it into cash. So when the market shows volatility like it is right now and it goes down 3, 4, 5%, you have the ability to take cash, go down and buy wonderful companies that might have been beat up and quite honestly look like they're going to be growing significantly over the years. So that is not timing the market. That is just utilizing cash to buy in at a low. Timing the market is a situation where people, unfortunately, typically don't do well. They time things wrong. They find out, they think the market is at a low. They'll buy only to find it goes lower. They'll stay out of the market. I've got some people that I talked to, some investors, that they were out of the market in 2017 because they bought the fact that the stock market is going to crash. Well, you know what? Markets do correct, and they will correct. But for anybody that knows a specific time or a date, I don't believe it. So don't try to time the market. We'll talk about some of those numbers where people have been out of the market trying to time the market, and it really hurt them. The other thing, too, is some of the most successful investors that we see do carry cash consistently. And part of the reason is if they get into an emergency or a situation where they need money, the cash is built up there so they don't have to cash out of any of their investments if the market is doing really well. So it just seems to be a trend that if you see a successful investor, chances are they're holding cash in their portfolios or outside of their portfolios. The other reason for building cash, too, we tell people that when you invest, whether you just start or you're in your 50s or 60s, we'd like to see you put aside 15% of your income for investing or saving purposes. So I said investing or saving. So some of that 15% can go into cash. So don't feel like you have to put everything you possibly have into the market. Put some cash aside. If the market corrects itself a little bit, it's a wonderful buying opportunity for you.
Good point, Sir Dean. And just to elaborate on what you said, we're all about not trying to time the market. And an old saying that we use is it's about time in the market, not timing the market. And to kind of illustrate that point, I have a couple examples here that were done by American Funds, a mutual fund company that believes in the long-term approach to being invested, not trying to go all in or all out in cash and then trying to time it and go back in. Nope, it's about investing over the long term. And one illustration that they published is about an investor who invests $10,000 into an S&P 500 index fund starting in January of 1996. So if you go back from January 1996, then every year over the last 20 years, they invested $10,000 into that S&P 500 index fund, and they somehow managed to pick the very best day to invest. So when I say the very best day to invest, you think about it, it's the low. You always want to buy low, sell high. So if they invested on the market low of each year over the last 20 years, they would have averaged an annual rate of return of 8.82% per year. So not bad at all. But historically speaking, it's impossible to do that. No one has ever invested $10,000 on the market low of each year and over 20 years. And I think it's pretty safe to say no one in the future will invest on the exact market low of each year over the next 20 years. But if you did from 1996 to 2016, you would have averaged 8.82% per year. Now, on the other hand, if you managed to invest that $10,000 into that same index fund starting back in January 1996 every year over the last 20 years, so same exact scenario, but instead you pick the worst date to invest each year, which would be the market high of every single year, you would have still averaged 6.58% per year. So from 8.82 to 6.58. And again, I don't think that's ever happened either, where you invested on the market high of every single year. But if you invested on the market high of each year from 1996 to 2016, you would have still averaged almost 6.6% per year, even though you invested during the market high. So with that said, at the end of those 20 years, the cumulative investment of $200,000 that you invested on the market high of each year had a value of $399,055. So that right there tells me that, timing isn't critical to long-term success. It's simply investing over time and being in the market. It's your time that's in the market. And a little quote by Dave Ramsey. We're big Dave Ramsey advocates, but one quote by him that he said before is, the only way that you lose is if you jump off the roller coaster while the ride is still going. So that's something that you don't want to do, meaning if the market goes down a little bit, that you completely cash out and you stay out of the market. That's jumping off the roller coaster while the ride is still going, something you don't want to do. Instead, what you want to do is dollar cost average. And what that means is you have a fixed dollar amount where, let's say you invest $100 per month into an investment, or $100 every single year into an investment, simply investing each and every single year the same dollar amount, because over time, that's a better way to invest over time. It's simply time in the market, not timing the market. Trying to jump in and out of the market during any little drawdown, it can be a recipe for disaster and can result in a financial plan that's no longer accurate. Because, if you're in the market in a fund that's averaging 6% per year, but yet you jump out for a couple of years, that's going to take that down. That's going to skew a whole entire financial plan. So big takeaway here, it's about time in the market, not timing the market.
Okay, good points, Tyler. Before we continue, we're going to take a quick break.
You're listening to Dean and Tyler Listle, investment advisors with Secure Retirement Solutions, located on Allied Street in Green Bay. For a complimentary review of your current investments, or if you have questions, please call them at 920-347-9888 or go to their website at srsplans.com.
Okay, we're back. We're going to talk about the next topic, and that is consider momentum investing versus value investing. And what we mean by this is we see this mistake made often, and that is people will constantly look, especially if they're self-managing their own portfolio, more so than if they're working with an advisor. We see this. If they're self-managing, they hold a basket of stocks that they're trying to buy at an all-time low. They're trying to be Warren Buffett, okay? Now, there's a couple big differences between the everyday investor and Warren Buffett. First of all, you don't have the funds to be able to buy and hold the way Warren Buffett does. Secondly, remember, because of the amount of money in the shares that are purchased by Berkshire Hathaway, they can have a positive move in the market of 0.5 point on a stock and make millions of dollars. Typically in your portfolio, you're not going to see that kind of dollar increase on 0.5 percentage point on a stock. So you're talking small incremental jumps that most of the stock at Berkshire Hathaway go through that result in millions, if not billions of dollars. So having said that, if you carry a basket of constantly waiting for the market to settle on the bottom for a particular stock, many times we see these individual stocks languish down there for a significant time period. Again, in 2017, if you just value picked, you bottom picked, you were a bottom feeder on particular stocks waiting for it to bottom out, many of those stocks stayed down that particular time. So you had one of the biggest bull markets in the history of the stock market in 2017, and you were stuck with a lot of stock positions or investments that languished. So you missed out on significant growth. So what we tell our investors is, we look at a good balance. We like to stay well diversified. We like to spread the investments out as wide and thin as we possibly can. But at that particular time, we also believe in momentum investing too. There are some stocks that have grown significantly, and buying into them right now is not necessarily a bad thing to do, even though they're at an all-time high. There are some stocks that if you quit buying because they were at a high, you'd never be in them. People could say that about Amazon. At $800, it's too high to get into. And at $1,000, it was too high to get into. And at $1,100, it was too high to get into. And at $1,500, it was too high to get into. And they're still not in Amazon, for whatever reason. But the momentum, and I use that as an example. Again, I'm not making a recommendation, but using that as an example. Momentum investing is very important, and there's some indicators you need to look at. You need to look at volume. So for instance, some of these stocks, what we see is just significant volumes of people buying volumes. That means there is momentum in that particular stock. Look at what sector it's in. Look to see what stage of the business cycle we're in to see which sectors are performing. Right now, tech is performing very well, with the exception of some of those that are hit by sanctions and tariffs. Okay? So look at momentum investing. It's not a bad situation to get on the bandwagon of certain investments that are going up, provided you look at some of the fundamentals of that particular stock before getting in. Tyler, anything else when it comes to momentum investing?
Good points there, Dean. I just want to elaborate on that a little bit. So momentum investing, it focuses on buying stocks that have been on an uptrend, hoping that they continue on that uptrend based on their underlying metrics, the sector that they're in, their business strategy, different things like that. It's one thing to buy a stock that's been on an uptrend, but yet that uptrend is kind of tailing off and they might be stale for some time. It's another thing to buy a stock that's on an uptrend and that you foresee it continuing on that uptrend. But the momentum investing philosophy is simply buy high and sell higher. So again, that whole concept behind that is that you can make a profit quicker. Your stock can gain money. It can rise in share price quicker in a momentum stock as opposed to buying a stock that is perceived to be undervalued or value investing and waiting for it to go up in share price, which can take multiple years at times, sometimes even a decade. And again, we're not making any recommendations, but I just want to give an example to illustrate how momentum versus value investing might work. So AT&T stock, that would be considered a value stock, which a couple years ago people considered that as undervalued. But you have the 2017 stock market where the S&P 500 did about 22% rate of return that year, and you have certain value stocks that are actually losing money. Well, that's kind of hard to stomach when the S&P 500 index made 22% and you have a single stock that actually lost money, but yet you're waiting for it to turn around and go up because you perceive it as being undervalued. Whereas if you would have sold it off, took the proceeds and invested in more of a momentum stock, you probably would have made gains a whole lot quicker than holding onto that value stock. And like you mentioned, Dean, there's a lot in the tech sector and the healthcare sector, but Amazon is one that's considered a momentum stock where it's at all-time highs right now, but it continues to go up. Again, not making a recommendation, simply illustrating how Amazon is right off its all-time high right now, but many people foresee it continuing to go up. It's a momentum stock right now. And the other thing when we talk about momentum investing is the current market that we're in can be good for momentum versus value, just because there's a lot of stocks that right now the price is high, their PE ratio is very high, and the stock market is viewed as inflated. So you're not going to find too many undervalued stocks as it is right now. There's going to be more momentum stocks, so that gives you more of an opportunity to invest in those stocks because the market as a whole is just off all-time highs right now.
Okay. A couple other items we're going to talk about here is internal fees. Tyler and I talk about this a lot. We try to be as efficient as possible, meaning that efficient in this industry means cheap. You need to understand what goes into the fee structure of your account, whether it's a managed account, whether you're self-managing. Understand what the internal fees are. Fortunately, we're in a world right now where it's easy to find this information. You can go to Morningstar, you can go to investor.com, you can go to Yahoo Finance, wherever it is, and you can find out fees within mutual funds and exchange traded funds. However, one of the big misperceptions out there is people think a no-load fund has no fees. That's not necessarily true. A load is a commission, but it's only one of 2 or 3 fees that typically are in mutual funds. Okay, so understand that a no-load fund does not mean it is fee-free. Inside mutual funds, which is typically one of your more expensive investments outside of maybe a variable annuity, is you have everything from loads to administrative fees to 12B1 fees and so on. You get more efficient when it comes to internal fees when you look at exchange traded funds, ETFs as people refer to them. ETFs are more efficient not only from a fee structure, but also from a tax structure. Okay, so understand the difference between the two. If you don't know the difference and like somebody to take you through them, give our office a call, come and see Tyler and I. We'd be more than happy to explain it. And then really when it's the most efficient, you're looking at stock. Single stock really have no internal fees that you're hit with. Typically the only fees if you self-manage is to buy or sell them, or your advisory firm gets hit with a fee to buy or sell them. Tyler, anything else with internal fees that people should be aware of?
Yeah, Dean, just as financial advisors, a big thing is to try and keep the fees as low and reasonable as possible over time. I tell clients if you want to get more information on investment fees, go to Morningstar.com. It's a free investment research website where you can simply see all the internal fees that you're paying with any of your funds. If you're paying a front-end commission, if you have what the internal expense ratio is, just a bunch of different things like that. And simply that'll give you as an investor tips on knowing your fee structure, know what you're paying, because over the course of 10, 20, 30, 40, 50 years of holding an investment in the market, a mutual fund, an exchange traded fund, any type of fund like that, even a couple 0.02% to 0.05% per year can add up over the long term. So simply know what you're paying in fees. When you can become more aware of that as an investor, that's going to make you a better investor over the long term. So know what the internal fees are. Again, Morningstar.com is a good website to go and get that type of research done.
Good conversations here, Tyler. That's all the time we have this week, folks. See you later and hope you'll join us again next week.
We'll see you next week.
You've been listening to Secure Retirement Solutions with your hosts, Dean and Tyler Listle, fully licensed retirement specialists from Secure Retirement Solutions in Green Bay. To get more information from Dean and Tyler, contact them at Secure Retirement Solutions on Allied Street in Green Bay. Call 920-347-9888 or visit them at srsplans.com. Securities and investment advisory services offered through Brokers International Financial Services, LLC. Member SIPC. Brokers International Financial Services is not an affiliated company.